Since the March 2026 war, the United States Navy has locked down the Strait of Hormuz, halting commercial traffic through this critical energy corridor. This blockade has triggered a dual economic shock: the domestic collapse of the Iranian rial and a global surge in crude oil to $120 a barrel. The blockade is functioning as a foreign exchange contagion, forcing oil importing nations to devalue their currencies to pay for essential energy. Inside Iran, the domestic economy is buckling. Tehran's infrastructure now supports a population facing extreme post-war strain. This chart tracks the rial's value against the US dollar. We see a steep collapse, dropping 15% in 48 hours to 1.81 million. The fallout is immediate. Inflation hit 67%, and over 1 million jobs have been lost since the conflict began. Internal policy responses are accelerating the damage. A prolonged internet blackout is costing the economy $37 million every day, paralyzing small businesses reliant on digital payments. With severe hyperinflation and mass unemployment converging, the government is draining its National Development Fund just to import basic food, pushing the state to the edge of unrest. The U.S. naval blockade physically targets maritime logistics, preventing commercial tankers from clearing Iranian ports. This map highlights Karg Island's geographic vulnerability. 90% of Iran's crude exports move through this single choke point. Because tankers cannot leave, the logistical chain is backed up, and onshore storage tanks are rapidly filling to maximum capacity. Once storage is full, Iran must shut in its production. Halting output in mature fields risks permanent, irreversible damage to the pressure within the oil reservoirs. Global markets are reacting to these physical supply limits. Brent crude prices have been driven aggressively past $120 a barrel. The massive energy price shock acts as a financial tax on oil importing nations, heavily straining their domestic currencies. In India, the rupee has hit a record intraday low of 95.34 per US dollar, triggering massive sell-offs in Indian equities and debt. Simultaneously, the Japanese yen is testing historic multi-decade resistance at the 160 level against the US dollar. The combination of high energy costs and a strengthening US dollar forces these oil-dependent economies into a liquidity trap, exporting inflation worldwide. In the next quarter, Iran faces a high risk of hyperinflation. If the blockade persists, the economy is positioned for a potential domestic collapse. Globally, central banks are now under pressure to hold or hike interest rates to combat the $120 oil shock. With energy costs high and regional currencies in retreat, the US dollar maintains its leverage over emerging markets. This sets the stage for a prolonged endurance test of global trade.